Well, let's get your perspective on the markets, because I was chatting to Brett Duncan of Standard Bank earlier this morning, and he was saying that there seems to be a winter for sale sign on the markets at this stage. And locally, it's that resources segment that seems to be on promotion. Your reading of the markets right now?
Well, I'm quite encouraged by the fact that the resources sector has made a recovery, and I think it's an acknowledgement that worldwide the markets are not expected, or the economy of the world is not expected to slip back into a double-dip recession. Yes, the pace of recovery is definitely going to be slower than had been hoped for, but I do think it's likely to remain positive, particularly in South Africa. But where we were looking for a 4% growth in GDP, we may be lucky to get to 3%. But you know, over the longer term, that's still positive, and that's what counts.
Do you think investors at this stage have managed to get a hold of their senses and, take cognizance of that kind of reality, as opposed to, get swept up in the panic mode and panic selling that we've seen engulf global markets over the last couple of weeks?
Well, perhaps, but I think when markets have come back from their record ever peak, well, yes, there is a little bit of panic because people got over leveraged again. But there's the old saying, if you haven't panicked yet, you don't understand how severe the situation is. It is severe, but I don't think it means that throw stocks out at any price. Certainly, if we went up towards the highs again, I would be inclined to take profits on stocks I'd held for some time, and I would be a very discriminating buyer right now.
Well, we've seen the financial and banking sectors in particular pulling into negative territory this afternoon.
Yes.
What are you making of the kind of activity we're seeing in that sector specifically?
Well, I think, look, I can tell you, banking is a tough area to operate in at the moment. It certainly is. But the bad debt exposure is improving. I think the access to funding is reasonable, and it's certainly the margins, while under pressure, are not getting squashed anymore. Mm-hmm. So I don't think that they should pull back too much further, quite honestly. And one may be justified in looking ahead and saying, if there's any unnatural pull down, there could be buying opportunities presenting themselves there.
Well, banking certainly not the only sector that is facing much headwind at this stage of the game. Let's hone in on a couple of other sectors, and we've had company earnings from those respective sectors filtered through this afternoon. Harmony out with numbers with a 67% drop in quarterly profits. You're reading off the kind of scenario that gold miners find themselves in right now, because once again, it's that that usual suspect of increasing labor costs and electricity costs that have come to bear on the miner.
Yes, undoubtedly. And certainly for a company like Harmony that has quite a lot of exposure to the older, low-grade, high-cost mines, it's a very real threat to them. And, of course, the fact that while revenue is earned in dollars, costs are measured in rands, and that has squeezed them quite considerably. Those results were a lot worse than the market had been anticipated. And of course, with the labour movement demanding very high wages and no increase in productivity, I think what's going to happen, we're going to see more of the development that we've seen that Anglo Gold are doing, talking about mining 5 kilometres below ground level. And how they're going to do that? Automation. They're not going to send people down to these new areas, and I think that's a threat that could come through to all of the mining sector, a threat to the labour movement. But it just shows how innovative the South African mining industry is, that they're prepared to take on these sort of challenges. I think maybe that's a pointer to where there could be gains in the future. And
yet we had those comments from Finance Minister Pravin Gordhan come through that Africa may be becoming the world's workshop for future labour. I mean, what's your reading of that kind of rhetoric that's hit the markets, where he cited the risks of rising labour costs over in China, putting us in that position moving forward?
Well, yes, their costs may be rising, but they're starting from a lower base. For instance, in South Africa, the average worker here earns, I think, 4 or 5 times more than the average Chinese worker. What's more important, though, is their output per worker, their productivity rate is much higher. There's a different sort of work ethic, and I think that is perhaps not going to give us the same sort of opportunities to involve in labour development versus favouring the Asians.
Well, let's quickly check in on Group 5's numbers, of course, shy of expectations, but looking at core earnings, adjusted fully diluted headline earnings per share down roughly 40% and in line with what has been a broader industry trend. You're reading off the numbers there?
Well, it just goes to say the construction industry is best stayed away from. I don't think one has to look at it for quick recovery either. It's quite clear that government and state-owned enterprises have pulled back from significant infrastructure development. Post the World Cup and the stadiums that were built and all the infrastructure around them, there's been very little activity. In the housing market, it's the same sort of thing. The demand isn't there. Where there is demand, affordability is a problem. So I think it just goes to say that the accent is no longer on infrastructure development. That means it's awfully difficult for the construction sector. I would just leave them alone for the time being.